Welcome back. Major banks kicking off fourth quarter earnings season with surging profits. Bank of America reporting a double beat, more than doubling its profits to $6.67 billion. Take a look at the numbers. Investment banking fees skyrocketing 44% to $1.7 billion. The stock this morning moving fractionally, as you will see here. And joining me right now from Davos is the chairman and CEO of Bank of America, Brian Moynihan. Brian, great to see you.
It's great to be here again on a beautiful, looks like it's been another beautiful day here.
Yeah, it's actually warmer here than it is in New York. Unbelievable.
I think a lot warmer.
Yeah, exactly. But I want to get your take on the new policies that we're talking about. A lot of people are excited about deregulation for the banking sector. Is that the group, do you believe, in your business is the biggest beneficiary of some of these policies coming out of the Trump administration?
I think it's across the board. If we were sitting here last year, the issue of business, there was inflation and interest rates, but another big issue was the amount of regulation in small to medium-sized companies and in the banking system and in large companies. And the feeling is that will now swing back to more normalcy. It had swung way too far. In the last administration, we tried to explain to them that was going to cause them troubles because I've said to people, our workers do a great job for our clients. If you come in and say they're all, doing bad things and stuff, it's just not true, and they don't believe it. And so the idea of bringing that regulation back has spawned a lot. The ability to get deals done has spawned a lot. Will we be beneficiaries in our industry? I hope, because we have excess capital, excess liquidity, all this stuff. That'll be helpful. But I think it's more important that the general economy feels a little bit of relief on regulation across the board. The ability to get deals done. American companies can now go out domestically and around the world and be the kings that they're supposed to be.
So what specific regulations do you think were the most onerous? Is this largely about holding capital, Basel III? What specifically do you want to see changed?
In the banking side?
Yes.
It's kind of all the above. So to make it straightforward, in 2019, when people thought we had enough capital, and it was said by all the chairs of the Fed and every capital industry is right, to now we went up about 20-25% for the same risk. And the reason why is behind the scenes, all these rules kept ratcheting up, and nobody was saying, wait a second. The GSIB, which is a tedious concept for most Americans, but it was an index.
These are the globally most important banks.
Right, and it was an index. It was supposed to be indexed. And so I think our appeal to them was, wait, just keep, the idea is we have lots of capital. We have less liquidity. 4 or 5 years ago, we helped you recover from the pandemic. We helped you through the regional banking crisis. It's clear that we don't need more capital because someone in Europe calculates something very differently and thinks that the numbers are the same when they're not close. So, and if you said it's 100 basis points for us, that's $200, $300 billion of loans we could make, and that would be good for America. So you have to keep the cost-benefit analysis much more fine-tuned. So it's capital, it's liquidity, it's the regulatory impact on consumer regulations, it's regulatory impact on not allowing banking mergers. That's not important for us because we're not doing, but not allowing banking mergers to take place, because at the end of the day, the consolidation has to take place by the choice of the customers, the clients. If they want to sell, fine, and they can sell to somebody. But the scale of institutions has moved, and you got to have to be competitive. You got to move, or you got to have a different business model, and both will survive. But right now, they weren't letting one happen just because they said they didn't like people getting bigger.
Yeah, well, for some reason, they were against anybody getting bigger. The deals, and that's about to change. President Trump changing the leadership in all of these agencies, from the FTC to the DOJ. So let me get your take on 2025. You were on a panel yesterday called The U.S. Economy in 2025. What would you expect in terms of M&A, in terms of capital markets businesses like IPOs? So
if you look broadly, the backdrop now from our research team, which is the best in the world, is 2.4% growth for GDP in the United States in 25. They probably added 100 basis points to that aggregate growth rate over the last 6 to 8 months. And that's, last year we were talking about soft landings. No, it's just trend growth. And so that's a good backdrop. Without having to take the risk of getting approvals through, that means deals will go through. So the M&A pipeline was full. There's a lot of conversations taking place. You just couldn't complete a transaction. And then the second thing is a lot of private equity firms had IPOs ready to go and needed to get into the market, but with the strength of the market, 2 years of 20% type of increases, with the IPOs have gone out in the market, and they have to be companies that earn money and have a good or being very discrete businesses. Those are getting done and they're trading up. Therefore, that says the capital can be put to work. So all that bodes well. You saw investment banking fees up 44% fourth quarter over last year's fourth quarter, nearly that for the year. But the enthusiasm by our team for what's ahead of it is far greater than it was the fourth quarter, because that was sort of under the old regime.
And I guess in the last quarter, you just reported it's your global markets business was showing growth for the 11th quarter?
11th quarter in a row. You had Jim DeMar on a few weeks ago, and 11 quarters in a row, year-over-year growth, which is a steady growth rate. Jim and the team have done a great job. So Matthew on investment banking has done a great job. Jim on the trading side, and we just keep growing that business. $900 billion of balance sheet deployed for our clients, and he does a great job. But they keep walking up. Some people go up and down more by market conditions, but our job is to continuously grow that every year, and he's done a good job doing it.
And of course, you came into this company at a terrible time during the global financial crisis.
Remember, Maria.
Oh, I remember. And it was scary.
Yeah.
During the global financial crisis, you are now celebrating January 1st will be your 15th year at B of A. What incredible growth on your watch. Tell me how the environment is different today.
Well, look, in those times, we weren't sure whether the industry was going to survive or how it was going to be structured. We weren't sure whether the governments around the world were going to be able to withstand this. We weren't sure the consumers that would over-leveraged were going to have. And we worked through all that. And for the last 10 years, it's been about organic growth in our company. And what we take pride in as a management team is our customer scores are highest, our employee scores are highest, the business organic growth is strong, and that's generated $27 billion round numbers in earnings last year, and that's success.
That's incredible. And I know when you first came in, you had to cut expenses. How are you controlling expenses today? You've been conservative in terms of controlling expenses your whole career at B of A. How do you do that while also ensuring that you're seeing growth?
So, here at Davos, the only other topic beside what's going on in America, what's going on in the election that is discussed is AI. And at the end of the day, AI is a continuation of the digitization. So when the management team took over, and I took over in 2010, we had about 290,000 employees. We went up to 305,000. We have 213,000 today. The nominal dollars of expense we ran on 67 billion or whatever it was, is the same as we ran the company on in 2016. The compensation levels are up, even from 19 to now, are up 25 to 30%. So how'd you do that? Automating processes, taking out work that doesn't need to be done, and then plugging the money into growth. So we spend $4+ billion in technology initiatives every year. We probably spent $2 billion back then. And so you just keep taking money out, using that automation, digitization, the change in customer behavior, Zelle, deposits of checks, all the different techniques allowed us to continue to take expenses out of things that weren't providing the value the customer wanted, the client wanted, and plowed into the back. And even in the trading business, Jim and the team took the break even per quarter down by $1 billion. So when you were talking to him, he said, it's not only revenue growth, it's profit growth. And that's what he's been able to drive too.
Yeah. And I guess rates have had an impact. I mean, we saw a little spike at the end of last year, and we're still talking about mortgage rates that are up there. What is the state of housing right now and mortgages?
So if you think about where the higher rate structure really affects America's people and businesses, it's around housing and a little bit on autos in the consumer side, and around small business and middle-sized companies borrowing, because they borrow on lines of credit. So when SOFR was 50 basis points and you put 300 or 400 basis points of spread on top of it, now you had 500 basis points. That's a lot more borrowing costs. So those two areas had the most effect, and that's what the drag. Housing, we originated $5 or $6 billion last quarter. It's been kind of steady, so that's kind of a rollover, a natural thing. Rates, I think. Part of it is for 15 years we had such a low rate structure. It's just getting people used to that. This is okay. You're earning more. You're going to be able to pay more. But to getting that in sync from a visceral level, when I have a 3% mortgage and I want to move to another house, I'm going to pay 7. You're like, that's crazy. But the reality is 7's more normal than 3. And so it'll take a while to work through the system, but it will keep housing a little bit slowed down for a while, other than the usual things of people just moving up or don't have a house and have to get a house because they had kids or something. Those things will go on. But the idea of incremental, a lot of movement in housing is going to take the rates coming down or stabilizing here for long enough, people honestly just get used to it.
Well, you're right. I mean, it became sticker shock, right? So people want to buy the house, want to take out the mortgage, and then they realize what it's going to cost them every month. Does that play out in that way that then they say, okay, it's too expensive, I'm walking away from this mortgage?
No, the delinquencies are really at all-time lows. So
no, but in terms of when they want to take it out, then they realize the payments, then they can't do it.
Well, they just don't buy the house. Right. They don't move up.
And do you see that?
Nobody doesn't pay you because they don't decide not to pay, it's usually they get sick or divorced or something happened to them, or laid off or something. So the American consumer and credit side is in very good shape. The charge-offs in our company, 50-odd basis points last quarter, and everybody says, well, it's come up. It's come up to a level sort of around 2019, which was a 50-year low in the company's history. So this is a very benign credit cycle, and we made it through some really interesting things. The pandemic, the regional banks, the unemployment rose in the pandemic. It took a while to get down. So credit's pretty good. Commercial real estate's still working through, but getting in better shape each quarter. For us, it's never been a problem, and the charge-offs have fallen for 3 quarters in a row. So we feel good about the credit.
Brian, do you want to say anything about this OCC consent order against B of A in terms of the Bank Secrecy Act? Investors are talking about it.
Well, that comes out of an examination a year plus ago, and we've done all the work. And we spent a lot of money last year sort of improving our processes, which all were pretty good. And it's just work.
Let me end where we began in terms of investing in America right now. A massive investment President Trump announced, $500 billion in AI and data centers. Do you see more of that? Are people poised, from the people you're talking with and your clients, to invest in America?
Well, if you go back to the first Trump administration and the tax changes, that brought America's tax rate down to where it was competitive. America always has great final demand, big market, biggest economy in the world, growing, et cetera. America has good business conditions in terms of talented people, worker flexibility, and all those types of things. And then the other thing it has is the tax rate was out of line, and it came down. So you put all that together, it was a great place to invest. You go in and say, now I'm going to move the regulation back, and now I'm going to create even better conditions. The investment, when you talk to the people around here from all over the world, the business, it's the #1 place to invest, not by a little bit, by a lot.
Wow. That makes a lot of sense to me, with adding deregulation on top of everything else. Brian, it's great to have you this morning.
It's great to be here.
Thank you so much.
Thank you.
Bank of America Chairman and CEO.